Internal audit is an integral component of modern corporate governance, providing independent and objective assurance designed to improve the effectiveness of risk management, internal control, and governance processes. Unlike external audit, which focuses primarily on expressing an opinion on the financial statements, internal audit adopts a broader perspective by evaluating operational efficiency, compliance, risk management, and organizational performance. International best practice recognizes internal audit as a valuable mechanism for promoting accountability, safeguarding assets, preventing fraud, and supporting the board of directors in achieving strategic objectives. Although the establishment of an internal audit function is not mandatory for every organization, many corporate governance frameworks recommend that boards regularly assess whether an internal audit function is necessary based on the size, complexity, and risk profile of the entity. Several factors should be considered when determining the need for an internal audit function. The size and complexity of the organization represent important considerations, as larger organizations generally possess more sophisticated operational structures, multiple business units, and greater transaction volumes that require ongoing independent monitoring. Organizations operating across multiple geographical locations or business sectors often face increased coordination challenges and control risks, making internal audit particularly valuable. The nature of business operations also influences the need for internal audit, with highly regulated industries such as banking, insurance, healthcare, and public sector organizations requiring continuous monitoring of regulatory compliance and operational risk management. Similarly, entities experiencing rapid growth, organizational restructuring, technological change, or significant acquisitions may benefit from enhanced internal assurance activities. The effectiveness of existing internal controls and governance arrangements also influences the requirement for internal audit. Organizations with complex information systems, significant cash transactions, valuable inventories, or heightened fraud risk often require continuous monitoring beyond that provided by external audit. A history of control deficiencies, operational inefficiencies, regulatory breaches, or previous fraud incidents strengthens the justification for establishing an internal audit function. Additionally, the Board of Directors and Audit Committee may require independent evaluations of internal controls and risk management processes to discharge their governance responsibilities effectively. Consequently, internal audit serves as an important mechanism for providing assurance over areas that extend beyond financial reporting and supports the continuous improvement of organizational performance. Best practice suggests that the internal audit function should possess sufficient independence, authority, competence, and objectivity to perform its responsibilities effectively. Organizational independence is achieved by ensuring that the head of internal audit reports functionally to the audit committee or those charged with governance rather than operational management. Such reporting arrangements reduce management influence and enable internal auditors to investigate issues objectively without fear of retaliation or undue pressure. Internal auditors should possess appropriate professional qualifications, technical expertise, industry knowledge, and continuous professional development to maintain competence in increasingly complex business environments. Independence and objectivity are essential because internal audit conclusions must remain free from operational bias and management interference. The operations of an effective internal audit function should follow a structured, risk-based methodology supported by formal planning, documentation, quality assurance, and reporting procedures. Internal audit activities should be based upon an annual audit plan approved by the Audit Committee and aligned with organizational risk assessments and strategic objectives. Engagements typically include evaluations of internal controls, operational efficiency, regulatory compliance, information technology governance, fraud prevention, cybersecurity, environmental controls, and value for money assessments. Findings should be documented comprehensively, supported by sufficient evidence, and communicated promptly to management together with practical recommendations for improvement. Follow-up procedures should monitor management's implementation of agreed corrective actions, ensuring that identified weaknesses are addressed effectively and that organizational learning occurs continuously. Internal audit also contributes significantly to corporate governance by strengthening accountability, transparency, and risk management throughout the organization. Through independent evaluation of governance processes, internal auditors provide assurance regarding the effectiveness of internal controls, strategic risk management, ethical culture, compliance frameworks, and operational performance. Their recommendations assist management in improving business processes, reducing inefficiencies, preventing fraud, and enhancing resource utilization. Furthermore, internal audit supports the Audit Committee by providing independent information regarding control effectiveness and organizational risks, thereby strengthening board oversight and governance effectiveness. Although both external audit and internal audit contribute to organizational accountability and assurance, their objectives, scope, reporting relationships, and responsibilities differ significantly. External audit is primarily concerned with expressing an independent opinion on whether the financial statements present a true and fair view in accordance with the applicable financial reporting framework. External auditors are appointed by shareholders, operate independently of management, and report publicly to shareholders through the auditor's report. Their work is governed by international standards on auditing and focuses principally on financial reporting risks and material misstatements arising from fraud or error. In contrast, internal audit functions as an integral part of the organization's governance and risk management framework. Internal auditors are appointed by the board or audit committee and report primarily to management and those charged with governance rather than shareholders. Their scope is considerably broader than external audit and extends beyond financial reporting to include operational audits, compliance reviews, information technology audits, risk management evaluations, environmental assessments, fraud investigations, and value for money studies. Internal audit reports are generally confidential and intended for internal use to improve organizational performance rather than provide external assurance to investors or creditors. Despite these differences, internal and external auditors often cooperate to enhance audit efficiency while maintaining their respective independence and responsibilities. External auditors may consider the work of internal auditors when assessing control effectiveness or planning audit procedures, provided the internal audit function demonstrates sufficient objectivity, competence, and systematic methodology. Nevertheless, responsibility for the external audit opinion remains solely with the external auditor and cannot be delegated. Together, internal and external audit functions complement one another by strengthening governance, improving internal controls, promoting accountability, and enhancing stakeholder confidence in the integrity and effectiveness of organizational management and financial reporting.